All right, good afternoon to everyone here. Okay, so my name is 𝗪𝘃𝘀𝗁. I'm from CSOP Asset Management. So we've heard from a lot of all these experts earlier on today with regards to where to look out for. You heard some within the China side of things, the US side. So it's no doubt that currently for investors, same thing like this Invest Expo, filling up for your next lap of investments, where shall investors look at? So at this current juncture, I believe most investors out there are chasing the AI theme, artificial intelligence theme. But I think the other AI that most investors should keep an eye out for going forward is basically ASEAN and India. So there has been a rising debate on where is the next lap of growth, where is the next China. And some say ASEAN can be the new China, some say India can be the new China. But we think we should keep an eye out for this space. There's a lot of geopolitical tensions going on, supply chain reallocation. Southeast Asia and India is slated to be the next phase of growth. So from our research, we have seen over the last decade, there were only 2 startups within Southeast Asia itself. But in 2021, there's been growth of up to 46 of these startup unicorns. And some of these companies that you guys may be familiar with are like the likes of your Caro, your Carousel. You do also have your Ninja Van as such. So these are some of these key unicorns that we've seen has been a growth within Southeast Asia over the last decade. So most of these investors might be wondering, hey, I just invest in the large cap tech. It will be sufficient. But why shall we look at all this, or why should we ever look at all these smaller companies? It's no doubt that while investing in big tech companies gives you exposure in that certain sector, but you have to take note that some of these mega cap tech companies, they are also the early investors of these tech unicorns, with the like of Gojek, your Lazada, Grab, SEA, to name a few. So with our studies, the PE and VC, basically your private equity and your venture cap investments have seen sharp growth over the last few years. Alone in Southeast Asia, it's seen a growth of over 100%. And this focuses a lot on the internet software services as well as some of these application and manufacturing services in India as well. So like the experts have shared earlier on, with all these global tensions going on, uncertainties, we have also realized that mega cap tech companies, tech manufacturers have since tried to de-risk their reliance on certain countries or try to reduce their concentration risk in a certain market alone. With that, you have to see from our presentation, both Apple and Samsung have since diversified some of their key supply chain, and some of your iPhones these days are manufactured in India. And going forward, your MacBook may also be manufactured in Thailand. For Samsung itself, they also have announced to build an EV battery plant in Malaysia. So with this, you can see that there are some capital flows and also the relocation of this supply chain towards Southeast Asia. So with no doubt, such capital flows, FDIs, or rather foreign direct investments, also seen a record high towards Southeast Asia, with financial as well as manufacturing leading the way. So with that, we also come to see there's also a group of these market leaders emerging. With the like of SEA within the region, Malaysia, Thailand, Singapore, you can see, for instance, Grab as well. Whenever you travel towards your neighboring countries for holidays, you realize that you can easily, there's nothing much you need to tweak around with the app. It will automatically in sync with the relevant markets and allow you to use it all along. So why Southeast Asia plus tech? The plus refers to India. So for us, we do have 2 bases of views why we came up with this theme. So first of all, we believe the sufficient and cost-effective labor, as well as the economic growth and rising income levels, will allow the internet adoption and also the industrial chain reallocation. So like all businesses, definitely the use of capital is very important. And to consider your workforces and the age group of your workforce is also a very, very important consideration. So China itself is a world-leading manufacturer, or rather the world's current factory. But the key note here is that you have to look at its median age of its population workforce. It's already almost a decade older than that of Southeast Asia plus India. And on top of that, the wages-wise, it is more than twice the average wage of Southeast Asia plus India workforce population. So with this proves as a very efficient and cost-effective labor forces for business to consider their relocation. The other segment to look at is also to look at the favorable policies by the relevant governments within the region. Like for instance, Singapore side of things, there's some tax incentive, and with that said, that's why you can see that most companies are trying to establish some foothold here in Singapore as well. So we believe this might actually be the fifth industrial transfer. This is not something new. I think over the last 100 years, last century, you've seen some of these industrial transfer. First off, the world's first manufacturing hub, UK to US, and then after World War II, from US to Japan, and Japan to the four Asian tigers, the semicon manufacturers like Taiwan, South Korea, Hong Kong, and Singapore. And from Singapore, and from these four Asian tigers back to China because of their cost efficiency and their scalability. And last but not least, what we are seeing right now, it may actually be the fifth industrial transfer from China to Southeast Asia. So there's also a surge in export led by high-tech sectors. So in fact, ASEAN saw a growth of more than threefold over the last 2 decades, whereas India exports also rose more than 7 times over the last 2 decades. And these are fueled by electrical and also these nuclear reactors and machinery parts. So with that, what do we have in return for all these high export figures? It also means that there will be a booming middle class and economic growth within this region. So with regards to research done by Morgan Stanley, it's slated that Southeast Asia's real GDP growth and forecast will be at around 5% going forward for the next few years. And for India itself, will be around 7% for the next few years, which is pretty much true. Last year, India saw a GDP growth of close to over 7% on this front. So with the booming middle class, for Southeast Asia-wise, there's also room for growth apart from Singapore. Singapore likelihood, our urbanization rate has been peaked, but whereas within the region, there's also a group of emerging markets that's slated for growth in that region. And with the urbanization rate, it also means that this new group of consumers will be exposed to new economies, digital economies, and it will contribute to 1/6 of the world's new consumer class by 2030. So with that, like I shared earlier on, as you can see, the workforce population, average workforce population of Southeast Asia plus India is only around 29 years young. So with that, what this actually means is also that this large young population also have a potential in the development of digital economy. So the adoption rate of internet services will be much faster than the peers within across the globe. So likewise, internet sectors have seen the strongest rebound over the last few years ever since the pandemic. As you can see from the chart on your right-hand side, yes, in 2020 and 2021, there's a decline on online travel. However, in 2022, once borders have been lifted, e-commerce came down slightly, but online travel surged. So with that, a strong economic growth, booming middle class, and also a huge growing internet users, what this actually means is that there will be potential growth within the digital space or the internet industry within Asia, Southeast Asia, and India. So why India? We incorporated India is also because we realized that India itself, more than 500 of its companies in India actually outsource their IT capabilities. And on top of that, more than 50% of the Fortune 500 companies outsource their IT development in India. So with that, this is the top 10 holdings of our CSOP 𝗍 Southeast Asia Plus Tech Index ETF. So over 50% of it is pretty much balanced, is focusing a lot on the internet adoption story, and whereas the other 50% will be focusing a lot on the industrial chain relocation story. So the ticker code for this CSOP 𝗍 Southeast Asia Plus Tech Index ETF is listed on SGX. The base currency is still in US dollars. It's also listed into two counters, one USD counter with a ticker code SQU, and the other Sing dollar denominated ticker code of SQQ. So the management fees of this ETF is at 0.99% per annum. So with regards to the index methodology, we focus a lot on the the country eligibility. So while some funds out there in the market today, they focus a lot on the country of listing, we focus a lot on the country of domicile, or where the relevant companies are headquartered at. On top of that, it's pretty much a diversified approach where business services, consumer retails, vehicle part and electronic components, as well as manufacturing and industrial services can form part of this index universe components. But the key note here is that more than 40% of the company's revenue has to be tech related to be eligible. So in order, we understand that tech is a very broad topic, and sometimes energy, certain clean energy can be considered as tech as well. But for that purposes, we have do some of these sector exclusions such as energy, healthcare, and some telco classification and utilities classification to remove it, to allow this to be a tech blend index ETF. So at any point of time, the maximum weightage for India domiciled companies are capped at 50%, and the maximum cap of a single stock is at 10%. This ETF will be rebalanced every quarterly, March, June, September, and December. So pretty much, I will just share the sector breakdown. I think most of you here will be wondering on where do all this revenue come from. It's pretty much diversified across the globe in terms of their revenue. As we can see, some of these global manufacturers, they have since relocated some of their industrial supply chain, and which is why you can see that this ETF actually is a very good hedge against the ongoing geopolitical tensions. So I think most of you here might be wondering how can Southeast Asia plus India perform comparing to its global peers. So the red line is actually demarcates the 𝗍 Southeast Asia plus India technology, the total returns, versus the light blue line is actually NASDAQ. So over the last 10 years, the annualized returns is at 12.2%, whereas the maximum drawdown is at 40%. So do take note that this is a relatively volatile fund, and if you have interest, to seek your relevant financial advisors or dealers for consult. So with that, our booth is just located at the corner. If you have further questions, just look out for me at the corner. I'll be happy to address them. And thank you all for participating and joining us this event. Thank you for listening, and Happy New Year to all of you.